In recent years, platforms like Wint have stirred up buzz by offering retail investors access to high-yield asset-backed funds, something traditionally reserved for institutions and HNIs. But is this really a game changer for the average investor or just another shiny product with hidden risk? In this deep dive, we will explore what Wint actually offers, how it works, the risk most investors overlook, and whether it truly fits into a long-term financial plan. No hype, no fear mongering, just a clear eyed look at the facts so you can decide if Wint is right for you. So, hi there, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So, let's start simple. Imagine you lend 10,000 rupees to a friend and he promises to pay it back with interest. That's exactly what a bond is, just more formal. So governments and companies borrow money from the public through bonds and promise to repay with interest. So why don't more people invest in them? Because bonds were traditionally hard to understand, hard to access, and frankly not very exciting. But the bond market is actually the backbone of the economy, and platforms like Wint aim to change how retail investors participate in it. So government bonds, also called G-Secs, are the safest bonds in India because they are issued by the government. The minimum investment amount is 1,000 rupees and you can invest through RBI's retail direct portal. But are they perfect? Returns may not always beat inflation. Liquidity can be an issue. The process is improving but still not fully user friendly. So yes, G-Secs are ultra safe but not ideal for everyone, especially if you're looking for higher returns. So here's where things get interesting. Corporate bonds were once reserved for big players due to high minimum investments, but recently SEBI reduced the minimum to just 10,000 rupees, making them more accessible than ever. The catch? Higher returns is equal to higher risk. So before you jump in, ask, is the company profitable? Does it have a good repayment history? Is it AAA rated or something lower? Because just chasing yield without checking fundamentals can backfire fast. Credit ratings help you assess the risk, but they are not foolproof. If you want a quick overview of these credit ratings, there's a small tabular column presented on the screen for your reference, which you can pause and see. But keep in mind, agencies have missed red flags in the past. Issuers pay for their own ratings, so there's a conflict of interest, and always look beyond ratings. Check cash flows, debt servicing history, business model. So the bottom line is use ratings at the starting point, not the whole story. And another thing to remember is not all bonds are created equal, and the difference lies in the collateral. So here's a quick crash course. Senior secured bonds are backed by collateral, so safest. Senior unsecured have no collateral, so more risk. Subordinated bonds paid only after seniors, so higher risk, and perpetual bonds have no maturity, so highest risk. In case of default, who gets paid first? Secured bondholders. That's why retail investors, especially conservative ones, should prioritize secured over unsecured or perpetual bonds. So Wint operates under SEBI's online bond platform providers OBPP framework. So what does that really mean for you? Does it guarantee safety? Not quite. It simply ensures basic regulatory compliance. So then, how transparent is the platform about risk? Can you rely on their due diligence alone? The answer? No. While SEBI's oversight reduces scam risk, it doesn't eliminate credit risk, the biggest threat in debt investing. So don't skip your own research just because the platform curated it. Wint specializes in senior secured bonds, often backed by collateral exceeding the bond amount. Sounds good, right? But pause and ask, who values the collateral? What if the collateral itself loses value? Does the platform conduct third-party audits of issuers? While Wint's vetting process appears robust, investors should look for external verification to avoid blindly trusting the platform's curation. And most bonds on Wint offer monthly, quarterly, or semi-annual interest payouts. But that leads to a dilemma. Does this this reduce your compounding potential? Is it better to manually reinvest payouts for growth or interest payments guaranteed? What if the issuer struggles with cash flow? Fixed pay cuts can be attractive for passive income seekers, but if you are chasing wealth accumulation, reinvestment is key. Also remember, fixed doesn't mean guaranteed if the issuer defaults. So minimum investment just 10,000 rupees. Great, but don't get carried away. Ask yourself, is this amount comfortable based on your financial situation? What percent of your portfolio should go here? Should your emergency fund be locked in a bond? Hint, never. Small ticket access is empowering, but only when it fits your overall asset allocation and risk appetite. So Wint Wealth offers a sleek platform with filters for credit ratings, yield, tenure, risk return profile. It's smooth, it's beginner friendly, but does the UI help you spot hidden risk? Are you relying on filters instead of fundamentals? Can user friendliness hide investment complexity? Think of the platform as a tool, not a financial advisor. Use it, but don't surrender your judgment to it. So who should invest in Wint Wealth? Wint Wealth isn't for everyone. It's better suited for investors willing to take high risk in debt, those with surplus experimental capital, individuals who can handle illiquidity till maturity. So before you invest, ask yourself, can I live with a potential default? What if the platform shutdowns or exits? Does this align with my financial plan and temperament? Wint Wealth is not where you park your savings. It's where you take calculated risk with money you can afford to lose. So Wint Wealth claims their bonds offer better returns than FDs and are less risky than equities. Sounds compelling, but let's look deeper. Equities are volatile, yes, but they rarely default. Your capital doesn't vanish unless you panic and sell in a downturn. Historically, markets recover. Bonds, on the other hand, can default. DHFL 2019 1,500 crore loss. ILNFS 2018 91,000 crore default. S Bank 81 bonds 100% loss for retail investors. Even senior secured bonds aren't immune. If the collateral's value drops or recovery takes years, your money is stuck or worse, lost. In contrast, equity mutual funds offer diversification, liquidity, professional management, long-term inflation-beating growth. So are Wint Wealth bonds really less risky? No, they are risky in a different way, quietly and permanently. So the takeaway here is, don't compare debt to equity on volatility alone. Compare them on risk of capital loss, liquidity, time horizon, and suitability for your goals. Smart investing isn't about picking a side, it's about knowing your risk and owning them. So let's rewind to April 2020. Franklin Templeton, one of India's most trusted AMCs, suddenly shut down 6 debt mutual funds. Just like that, 25,000 plus crores of investor money were frozen. Here's the twist. They weren't underperforming funds. They had consistently beaten FDs and were seen as a reliable middle ground between returns and safety. Until they weren't. The pandemic triggered panic redemptions. The bond market froze. Franklin's funds loaded with low-rated, illiquid bonds couldn't be liquidated. Investors were locked out of their own money for months. Eventually, most investors were repaid, but the shock was unforgettable. Strong past performance is no shield against weak portfolio construction. Now think about it. If a SEBI regulated AMC with decades of experience, daily NAV disclosures, and professional fund managers could freeze redemptions, what about unlisted bonds on platforms like Wint Wealth? No daily NAV, no regulated liquidity, no market tested history, no guarantee of principal. We are not saying Wint Wealth is unsafe, but let's be honest. Do you truly understand the issuer's business? What if the NBFC behind the bond faces a cash crunch? Who protects you then? Franklin investors at least had SEBI oversight. Here, the risks are higher and the safety net thinner. So credit events are like earthquakes, sudden, damaging, and hard to predict. Everything looks fine until one default triggers a domino. And that's the thing. These aren't fixed deposits with extra spice, complex debt instruments wearing an FD costume. Now compare this with mutual funds, so especially credit risk funds. Here's something most retail investors don't realize. SEBI mandates that mutual fund managers invest at least 20% of their own compensation into the very funds they manage. That means if the fund underperforms or faces defaults, the fund manager takes a hit too. Their skin in the game, and that creates a competitive, performance driven environment. On the other hand, platforms like Wint don't face that kind of accountability. Their team curates bonds, but they aren't directly penalized if a bond defaults. The promoters, employees, and platform itself remain unaffected even if your capital is at risk. And while SEBI regulates mutual funds tightly with portfolio disclosures, credit caps, liquidity stress test, and conflict of interest rules, the regulation around unlisted bond platforms like Wint is far looser. Yes, it operates under SEBI's OBPP framework, but that doesn't mean the bonds are SEBI regulated. So smart investors don't just ask what's the return. They ask what happens when things go wrong and who's standing beside me then. Because in debt investing, alignment of interest matters just as much as the yield. And let's say the bond doesn't default. You get your 9.5% return. All good. Well, not quite. The interest income from bonds is taxed at your income slab, subject to 10% TDS. So if you are in the 30% bracket, your real return could drop significantly. Now compare that with debt mutual funds with indexation benefits if it is held long term. RBI G-Secs, no TDS plus sovereign banking. Also ask yourself, is it worth managing 3 to 5 scattered payouts every month? Is your tax planner involved, or are you flying blind? Post-tax yield matters far more than sticker returns. So what are the key takeaways? Wint earns via markups, not transparent advisory fees. Know your yield, not just the pitch. Regulation under SEBI's OBPP doesn't guarantee safety. Defaults are still possible. There is no exit liquidity. You're locked in until maturity. Recovery in case of default is messy, slow, and uncertain. Prefer credit risk mutual funds if you're chasing higher yields. They offer instant diversification, daily liquidity, professional risk management, SEBI protection, and disclosures. Do you want safety with clarity? Then consider RBI Retail Direct for G-Secs, sovereign, transparent, and zero fees. Now, what is the final takeaway from this video? Let's face it, platforms like Wint know how to package risk attractively. Their bonds look stable, sound safe, and feel like a smart choice. But behind that promise is concentrated issuer risk, no market liquidity, no SEBI-like transparency, no plan B if things go south. So before you invest, ask yourself, can I afford a loss if the issuer defaults? Can I stay locked in for 2 to 3 years with zero liquidity? Am I trading safety for yield with no margin for error? If your answer is maybe, then pause. A certified financial planner can help you build smarter debt exposure through regulated mutual funds, balance yield, liquidity, and credit quality. Align your debt investment with your real world financial goals, not just clever marketing. Because in investing, peace of mind beats a few extra percentage points every time. Let's not forget, even Franklin's diversified debt fund shook during crisis. So what chance does a concentrated bond product have in a downturn? So do you want to invest smart, not just react to shiny returns? Then talk to a certified financial planner CFP before locking your money into high risk debt products. So click the link in the description to book your free consultation today. Invest where risks are known and exits are open. And if you find this video valuable, then give it a like, share, and subscribe to our YouTube channel. Until next time, thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, We also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.